I think this is going to be fascinating. Isabel Lee of Bloomberg News is going to be interviewing Omar Aguilar, CEO and CIO of Schwab Asset Management, the behavioral finance playbook, keeping clients grounded in a noisy market. Let's hear it for him. Put your hands together.
Hi, everyone. It's a lovely Tuesday afternoon. I'm very thrilled to be here with none other than Omar Aguilar. I feel like every time we talk about markets, we think about fundamental analysis, technical analysis, but we don't really think about as much as emotional analysis, which is just as important. And before I start, I want to admit that I'm a millennial, and everything Omar will be saying about millennials will be of special interest to me. Actually, who here are millennials? Let's get a raise of hands. Okay, good. Taking notes. What about, I have to look at my notes, Gen X? Will Gen Xers admit who they are? Great. Boomers? Okay, we see a few hands. And should I ask about Gen Z? 1997 to 2000? I see one hand. Two hands. Okay, three hands. Okay, we have a full representation here. So we're going to talk about how behavioral biases affect our investing strategy, how they are different across generations, and how they are similar. After all, we're all humans. And granted, this is just one categorization of how investors act. There's race, sexuality, gender, religion, marital status, and all that. But Omar, in Schwab's behavioral finance book, you mentioned that baby boomers, those born in 1946 to 1964, have really seen the market increase steadily throughout their formative years, which is why, generally, they're more confident investors. And millennials, people like me, have been scarred by the great financial crisis, have seen the pandemic, which generally make us a little bit more risk averse. So we'll dive deeper into that. But before we begin, maybe you can lay out the difference between the biases in your playbook. There's emotional, think regret, loss aversion, and there's cognitive, think confirmation bias or home bias.
Yes, thank you, and good to see everybody here. This is one of the topics that has been fascinating for me over the years. I did my PhD in decision sciences, and as I go through the different stages on how people make decisions, not just investment decisions, but in general, how people go through decision processes, it is quite unique that at the end, it is because we're humans that everybody has a different utility function. It doesn't matter how close you are in age, how close you are, in the way that you're brought up, anything else at the end, every individual has different decision process. And I'll talk about that in a second. The concepts of behavioral finance starts with just neuroscience, just the brain, the reason why we are different than the rest of these, live beings. And we have two parts of the brain that interact with each other. And I think all of you will probably relate to this. The internal part of the brain, that the amygdala, the limbic system, is the one that tells us the emotions that we feel. So many of you flew to California for this conference, which, by the way, I still feel overdressed here. See everybody in shorts wearing shirts. Not good. That was a bad decision on my part. But lack of information too. But anyway, as you flew into the, you take a flight, I am pretty sure that everybody have experienced turbulence. So think about this. When you actually experience turbulence, no matter who you are, you're gonna feel uneasy. Immediately you start feeling weird, and in some cases you start sweating, in some cases you start grabbing. That is the limbic system. You have no control of that. That's the emotional bias that we all have. This is the part that controls everybody else. Most teenagers, all driven by emotions. I have 3 daughters and a wife and a female dog. Guess what? It's all driven by emotions. Everything that goes in my household. Now, there is the prefrontal cortex that is the part of the rational brain that controls our decisions. This is what makes us different than the rest of the live beings out there. And what that is allows us to use information to center us, and then when the pilot comes on the phone, on the microphone and says, hey, we're just going through a little bit of turbulence, everything will be fine. As soon as you hear the words, it's gonna be fine, you immediately become uneasy. That means that your frontal cortex starts thinking, oh, things will be okay. I have actually lived this before. So your immediate reaction is emotional. Then you start rationalizing, and that's what is called cognitive. So the cognitive bias are those biases that you tend to use when you're trying to use information to convince yourself that things are going to be okay. Now, that doesn't necessarily mean that both of those are actually against each other. Sometimes they actually complement each other. But in any single places, that's actually what it goes in and out. Now, I'm going to actually go back to what I said here. These also changes depending on generations. I think you started talking about, baby boomers. You started talking about different pieces. So there's a lot of literature on baby boomers, how they were raised, how they compete for everything. There were no seats in school for them, so they have to basically strong arm each other to try to get to school first. They were the first ones to invest in Silicon Valley. They were the first ones to invest in real estate. They were the first ones to invest in private equity, et cetera, et cetera. You actually think about millennials. They're actually great. There's a big generation, lots of them. But guess what? Nobody talks about my generation. Nobody talks about Gen X. So I did some study to know, why do you think nobody talks about Gen X? And I think it is because it's a smaller generation, and then half of the Generation X behaves like baby boomers, and the other half pretend to be millennials. That is the ones that you see trying the skinny jeans and they pretend, which they don't fit. Those are the other parts. That's the reason nobody talks about Gen X, just because it's very hard to identify them.
So given the biases that you laid out, do we minimize them when we think about investing? Do we amplify them? Do we lean into them? How do we manage them?
Yeah, so we have done a lot of work, and we have created, for some of you that are interested in this, we have created a system or a process, and we have information that you can use that is called diagnostics. So the first thing that you have to understand is define your biases. And I think as advisors, you need to start by understanding your own biases before you can actually talk to your clients. Again, everybody has biases, no matter who you are. We're all, humans, and at the end, we're all going through that. The only difference is that you have been trained in how to manage the different parts of the portfolio of your clients. So think about it. In my example of the airplane, so you know that the pilot has been around and knows how to deal with turbulence. So that's exactly your role. Even though the pilots also get nervous, they also have reactions. That's actually how they do it. So now what we have discussed in this diagnostic system is basically said there's two things. You as an advisor need to decide what the client needs and what the client wants. Very different. So immediately you basically go and talk to your client and figure out what is that you think that they want. And they're going to tell you everything they want. Of course, they want higher returns, low risk, lots of income, no investment. They do a lot of things that they want. But you also know, depending on their profile, depending on their wealth, depending on their risk aversion, what is that they need. That is your role. Your role is to make that trade-off between what you think the client may need to achieve their goals and what the client wants, that most likely they're not going to be, aligned together. Now, when it comes down to cognitive biases, and I think as you started describing, cognitive biases are those that are used with data. Those are the ones that you can use to convince your client. For example, confirmation bias. Confirmation bias is one of those biases that you use information to convince yourself that things are going to go the way you are. For example, I think the economy is going to a recession. Okay, well then the next time that you actually see the data, the labor market report, you're like, yes, you see, I told you, it's gonna go into a recession. That is an example of a cognitive bias that is called confirmation bias. So on the other hand, you have the emotional biases. Those emotional biases are, for example, risk aversion. All of a sudden there's big spike in volatility, you get scared. Those are the ones that you react. So what we have discussed in this process for diagnostics is in this trade-off between what the client wants and the client needs is that for cognitive biases, you can use data to minimize the impact of those biases on your clients. For emotional biases, you're not going to have anything. There's no way that you're going to convince your client to change those. There's a nature on what they have. You need to adapt to those. So you need to adapt to their emotional biases of your clients, and you need to work with them on the cognitive bias to minimize the effect of those as they go into their investment strategies.
So I'm glad you brought up confirmation bias because I feel like with the prevalence of social media and information bubbles and all these algorithm of the social media apps that we have, you kind of see what you want to see. How do you minimize confirmation bias then? And do you see that more susceptible in younger investors or older investors?
Well, I'm glad you brought that up because the evolution of behavioral finance has been so fascinating over the last 10 years because of the social media and because of access of information. When I started my career, the only way that you actually could get information about the market is you have to go to a little TV that was on the trading floor and maybe get a fax from Reuters that will actually tell you how the market and some stocks that you have, or you need to go outside to try to look at what the tickers were actually going to go with the prices. Today, you have access to information instantly. So what that does is that creates two pieces of biases that are so critical for all of us. One is confirmation bias, and the other one is called recency bias. Recency bias is one of those biases that basically you pay more weight in the information that is more recent and less on the past. So what happens is you're paying attention to what is going to be the NVIDIA earnings at the end of the day. You pay more attention about what the CPI report will be tomorrow. You actually pay more attention of the headlines, and then you use that information to make decisions as opposed to try to look at more thorough analysis. Now, confirmation bias is perfect. You start with a theory, whether or not you're going to have certain investments. I think you heard from the previous panel about how you position yourself. And then as information starts going certain way, then you confirm that your theory is correct. And I think the challenge with those pieces is that you can see and you can find, and I have actually done this especially with ChatGPT, you can actually find information to confirm your theory all the time. There is always going to be a way to confirm, even if it's just one small piece, you can always find that information out there.
What about overconfidence? That's also a strong emotional bias. Do you see this play out differently across generations, particularly when it comes to the gamification of trading with trading apps or even financial news? To your point, everything is just Googleable now. There are hundreds of news organizations out there, although Bloomberg is still the best. But how do you see that happen?
Well, two things, and that's a great topic. On one hand, in terms of overconfidence, this is actually, a good example. And I'll do this. I have actually usually done this when there is a closed space, but I'll try to do that. So everybody here drives. So I would like to just see raised hands. Who thinks is a better than average driver? All right. So actually, for those of you that didn't raise their hand, I don't want to be driving with you. But I would probably say when I just count the hands, more than 80% of you raise their hand. Well, that's impossible because if every time I do this, you get most than 80 to 85% of people raising their hand. So clearly there's something wrong in that information. Now, when you actually think about the study of that, if you actually do the same thing, if you put a group of traders here and you ask, who do you think is better than average trader? You will get 100% of those guys will raise their hand. That's the nature of humans. We actually have that natural overconfidence. Now, I got to give you credit because, as I said, I have 3 girls and I have my wife. Females tend to be more, objective about their skills than guys.
Indeed.
Usually guys, and I tell this all the time because every time that we open a rec for a portfolio manager, this is true. We get 99% of the applications for a portfolio manager comes for males that a good percentage didn't even have the background. And when you ask them, why did you apply? It's like, well, I could learn. I'm a good learner. Instead, females tend to look at every single one of the pieces of the recs. And if they don't meet one, they will not apply. Again, very objective. But what that goes back into say, especially now, the biggest example of overconfidence is that for the last 3 years, the Mag 7 have driven the market and nobody wants to sell those stocks. Now, they have worked. They have actually done well. But overall, you can actually see that they keep on building that momentum as a way to show the overconfidence. Now, the other part of that particular bias is what is called FOMO, and that's a very millennial thing to do, the fear of missing out. And you have actually seen examples of fear of missing out in that particular cognitive bias, especially in the so-called meme stocks. So as people start to do the game stock, as things start looking at AMC, that was back then, and they started to look at other, stocks like that, and they basically go into that, not necessarily because of overconfidence, because they heard that it's a good idea, and they just go and buy it without any fundamental reason for it.
Do you see the same in digital assets too?
That's an interesting thing, and I would probably say that goes back to the initial part of the conversation where we're talking about generations. So millennials are kind of an interesting, set of individuals because, as you said, given the experience they had in the market, given their experience, how they brought up, in general, they tend to be more conservative. They don't necessarily trust regular capital markets. That being said, they are the first ones they actually save more money. They actually are good in their 401ks. When you actually look at saving for retirement, you ask, and at Schwab, we did, a couple of these interviews, millennials tend to be best among all generations for saving for retirement. They want to retire early. And therefore, they are very diligent about that. They don't like to buy, expensive stocks. They actually try to not stay in the market. That being said, they are the ones lining up for the expensive coffees, the pumpkin, iced lattes.
Or $7 matchas.
They're the matchas, which is like a big millennial thing, the avocado toast, and Bitcoin. So I don't understand. So you don't necessarily want to trade in certain areas, but you're really interested in buying digital assets. It's kind of an interesting sort of psychological and behavioral biases that millennials have.
I think Gen Z is also like matcha. If you look at TikTok, it's all about matcha, and all the coffee shops in New York where I'm based is just offering matcha.
I can tell you right now, we have a different. I don't actually even have a TikTok account.
You should open a TikTok account, Omar. Okay, what about the impact of herd mentality and recency bias when it comes to market volatility? How do you see that play out, and how should investors mitigate that?
Well, at the end of the process, and I think a big part of the role of advisors is precisely, as I was saying, understanding what is the long-term investment objective of your clients. A big part of your role is to, try to understand in the different dimensions what is their estate planning, what is their, planning in terms of, their objectives, or what is the information that you need to gather for their clients, including their risk profile and their biases, so that you can actually help them reach their long-term investment objectives. The big part of this FOMO, the big part of this herd mentality is that they will always come back to you and say, well, I just heard from my friend that, there was a great investment in such and such. And private credit is one of the good examples of those, or these alternatives, or these hedge fund, or these digital assets, or some of those levered, ETFs. A big part of, I think, the driver of this is what we call gold investing. So one of the things that we work with advisors at Schwab is to say, well, you should think about how to adapt your practice so that you can identify each of the different goals that your client has. The old days, you want to wrap everything else in one household, one strategy. The environment that you have today, very dynamic. What you basically want to say is you basically look at this and say, well, let's talk about your long-term investments, your plans for retirement. That should be in a low risk, I would say boring core investments that are low cost, index based, that they're going to just follow the market and follow the cycles of the economy. There will be another component if you want to generate income or you want to generate certain pieces where you can find another goal of another piece of your portfolio that will be dedicated for that. And yes, for those clients that have the desire to trade, that have the desire to just have that piece, you can actually associate a small goal that says, well, that is sort of a piece of your portfolio that you can use to trade, that you can use to find stocks, that you should find to get excited, but it's not necessarily going to change the investment objectives. And again, goal-based investment is such a big component of how you can work with your clients to make sure that they don't lose track of where they're going, but at the same time, you're adapting to their emotional biases or their cognitive biases, depends on how they are.
So based on your academic research and your professional experience, do you think it's better for financial advisors to advise clients who are in the same generation then? Or is there a beauty in advising someone who is in a different one and together you can bring best practices? What is your advice?
Well, the age and generation definitely it's a factor, but it's not the main factor. In many part of what the research that we have done, is that the main two factors that drive success in terms of wealth management tend to be the level of wealth and tend to be the discipline that you have as an advisor to support this. It doesn't necessarily if your client is risk averse or is risk taker. At the end, as long as you have a discipline on how to structure things, you can mitigate the effects of other biases. Now, wealth makes a big difference because in certain way, the wealth effect that comes by having a different balance sheet, allows you to make different decisions. Again, it's not the same thing to have a client that just inherited multi-million dollars that have a client that is just in the process of starting to invest for their retirement.
If I ask you which is the most difficult generation to handle, would you have an answer?
Yeah, you're killing me here. Well, I would probably say that the most difficult one, and I was going to say this because that's my generation, is Gen X. Mostly because you don't know where they stand. In other words, the Gen X, you have a conversation with them, and you don't know if they like what you told them. You don't know if they really just tell you yes, but they're not going to follow through. It's very hard. They're not as transparent as other generations. Baby boomers are incredibly loyal. They put a lot of value in a relationship. A lot of what you do in terms of your baby boomer clients, it's basically developing that relationships and that trust. The big part of the difference in generations when it comes down to building a practice is that if you can build the trust with a baby boomer, you will have that for a long, long time. Now, millennials, on the other hand, it's all about trust but verify. In other words, yes, you can develop that relationship, you can develop the rapport, but they're going to fact check you. They're going to fact check you all the time.
Google University is what they call it. Yeah.
I always give, I live in New York for many years, and I always, every time that I go, I usually call friends that live in New York and say, can you give me recommendations for a restaurant? And, just in my generation and baby boomers, if they tell you go to these restaurants, you go. You trust your source. When my daughter ended up going to New York for a visit, and then I suggested 2 restaurants, she didn't go. And the reason why she didn't go is because it only had 3.5 stars, when she looked them up. So that's the difference on how this works. So in generally, when you actually work with millennials, you actually have to use those cognitive biases because there's going to be a lot of fact checking. There's going to be a lot of information. You're going to have to send them. Actually, our team does a good job because they send them TikToks. They send them TikToks to be able to educate on certain parts of investments. Whereas baby boomers, it's a meeting. You're going to sit down in a meeting. You're going to explain. You're probably going to bring hard copies. You're going to actually explain pieces by pieces, which is actually just the way that you interact. So developing a relationship and a communication style is critical for the success of a practice.
I do love hard copies also, as you can see my notes. But, okay, Omar, we do have the stereotypical generational attributes. But how much does social media play? I mean, I feel like we're seeing an inflection point because when Bloomberg writes stories about retail traders, it cuts across ages. There are 20s, 30s, 40s. So do you feel like social media is blurring the lines across these generational divides?
Well, I don't necessarily think that social media is the driver of how these things operate. Markets are incredibly efficient. Now, what happens in this case is, the exchanges and the way that people trade, overall, when you have short-term, discrepancies, they tend to go away quickly. Now, again, there are certain asset classes where things are more inefficient. So a lot of the illusion of power that people may have by thinking that they're actually moving markets, it may be reflected in the short term, but in the medium term to longer term, things go back to the fundamentals. So I think what social media does is basically just creates the trigger to what we were talking earlier. So it's almost like turbulence in a plane. So if you have a headline, whatever is your favorite social media that you consume, that triggers a reaction. And in many cases, depends on who you are and depends on your utility function, you could react quickly and say, oh, get me out of the market now, or try to buy more, or try to do this. And that trigger, that emotional bias is the one that you as advisors need to work with your clients to figure out. So one of the things that our team has done in educating advisors and clients to this is, again, create a process. You work with your clients to say, well, believe me, there will be volatility. Yields will move. Stock market will move. What do you do in those cases? If you say, if things go above or below a range, let's 5% or 6% in a day, we're not going to panic. We're just going to stay calm and wait for the next data point. If things start to go above 10%, well, we're going to use that to tax loss harvesting if it's possible. Try to replace those with others so that we can take advantage of the volatility. We may be able to use derivatives to try to mitigate some of the volatility. So there's things that you can do in advance of the period. So this period of time right now where things are a little calm, this is the perfect time to make those plans so that you don't necessarily have to do it at the time where things are triggered. So yes, social media will happen and events will happen, and there's going to be a lot of headlines that eventually get to the client's head, and then you will get a call. I always tell people that it's almost like the IT folks. They never get a call when the systems are working. Like every day, 99% of the time where things are working, your network is great, the email is working great, nobody calls them to say thank you for making the systems work. But the day that the system is down, there's no Wi-Fi or something else, immediately you get like 200 calls to see what's going on. I think it's the same thing. If you set up a system with your clients, yes, they will still call you, but at least you can remind them that you had a plan.
We have a little over 3 minutes left, and I want people to have a takeaway from this panel. And Omar promised to share a bias that he had that went wrong professionally and personally, and I think we should trust him because he has multiple degrees. I think you have 2 masters and a PhD and all the fancy titles. So Omar, please don't disappoint us and share with us your experience.
Well, that was my first takeaway. With any academic you have, I still don't know what the market is going to do. That was my first disappointment. I thought that by going to school I was going to actually get an H, but no, believe me, it's not actually that easy. Well, 2 things. In terms of, disappointments, I don't necessarily call it disappointments. I also just think it's reality. I think it's a big part of that. I tend to have, my wife and I, know each other. We're all going to be 30 years married. And, what I thought is like we've grown up together. We have the same background. She also, got the same degrees as me. We went to school together, and I thought we had the same, utility function. So one of the anecdotes that I always tell is that when it comes down to getting on an airport, getting on a plane, I tend to be incredibly conservative. I am one of those guys that like to be ahead. I don't want to rush it. I don't want to hit traffic. I want to make sure that we're there. I have been in many circumstances where things could go wrong. And my wife is the opposite. My wife is like, well, the plane leaves at 1 o'clock. We can get to the airport by 12:15, 12:20. And so I'm like, we cannot do that. So there was one time where I said, I'm going to trust her. I'm just going to go and say, you know what? She's good. So we're going to go, and we're going to go to the airport, and we're going to try to get there. Sure enough, she was right. That's the thing. It was not a disappointment. It was a learning experience for me. She was right. We made it on time to the plane, but when I got into the plane, I felt like I had just run a marathon. My heart was racing. I was feeling bad. I was sweating. And then she was so calm that she says, oh, you know what, want to watch a movie? I was like, I need a tequila here. I cannot really, it's just one of those things where even though you may have 2 people that follow exactly the same piece, because of the way that we handled emotions, and this is the basic stuff, right? It's just not the same way to have. So again, it's not a disappointment. It's more like a learning experience on how, even when you think, oh, those people are going to be the same, and I'm sure you have clients that you can fit exactly the same profile, same level of wealth, same background, same everything, you immediately feel that it's the same. But now that's the case. Now, the second on the professional side is, I would probably say that at the end of the process, control what you can control. I have been in many circumstances where I have actually tried to take more risk when I can feel comfortable with. And at the end, it turns out that you actually feel what you think is the right thing for your client, and the level of comfort that you can have, what I call sleeping well at night. Make sure that wherever you have in your investment portfolio is something that when you go to sleep, you feel that is the right thing to do. And if you do that, you're going to actually have a successful career.
On that note, thank you everyone for coming. Thank you so much, Omar. Omar
you.
Aguilar, CEO and CIO of Charles Schwab Asset Management. Thank you, everyone.